Good evening, everybody, and welcome. It's really great to see so many people here. This is our first London tech event that we've run. So for me, it's really exciting to see so many people in the room, and also the variation, the variety. I was looking at the names of people that are here, and we've got such a good representation in terms of innovators, entrepreneurs, tech companies, farmers, investors. So I think that's going to make for a really interesting panel discussion. So the running of the evening is that you'll be hearing a little bit from myself in the first instance, just about the Agri-EPI Centre and what we do. I'll be handing then over to Emma from Barclays Eagle Labs, and we should say thank you to Barclays whilst we're here for this great venue. I'm sure you all agree it's a really great setting. And then we'll be moving on to the exciting bit that you're all here for, which is the panel discussion. Our panel will all be introduced to you at that point, so I'm not going to do that right now. So without further ado, this is not what I was intending on talking about, but we were having some conversations earlier on in the day at a different event, and some of the things that were sort of brought up, and it really does relate to our themes for today in terms of the landscape, the challenges, the potential solutions, the themes of sustainability running through the sector, and what that means in terms of innovation and technology. But some of the things that were being talked about at the event that I was at earlier was very much around how the farming landscape itself is changing, and how there is the growing population means that the need for food produced is by 2050 is going to have to have increased by circa 50%, but actually farmers are decreasing, and there's so many different sort of challenges within that in terms of what consumers are asking for, what legislation is asking for, and those challenges sort of encompassed within those challenges. So if I just give you a quick overview, because I think those sorts of things will feed very well into our panel discussion. So if I give you a quick overview of the Agri-EPI Centre, who we are and what we do, for those of you in the room that don't know. And then I shall hand over to Emma to do the same for Barclays, and then we'll get on to the exciting part. So the Agri-EPI Centre, as it sort of says on here, we're an innovation centre, and we are very much focused on the application of technology and what that means in terms of the application to farming systems to support sustainable development, but very much focused on precision technology and the development within that. So we are one of four centres. The four centres are government funded, and we cover the whole sort of field to fork supply chain in terms of the areas that we focus on and the areas that we're able to support. For ourselves at the Agri-EPI Centre, our focus is on the application of technology, and we describe ourselves as a facilitator. So our slogan is "Together we can," and I think that's, events like this help us achieve that. Bringing people together to collaborate, to speak to each other, to understand what we can do together to achieve some of those solutions to the challenges that we'll be talking about today. So I think in terms of who we are and what we do, our purpose, vision and mission is very much focused on that sort of field to fork supply chain. At the very beginning, we're talking about fundamental science and research, but what we do is we bridge that gap so we can take people through that journey, so that the science and the great work that comes out of academic institutions is developed by the technology and innovation companies that we work with, so that we can help them take those products, prototypes, those services through to a commercialised offering, which can be applied on farm in a practical way. So this just demonstrates sort of our innovation pipeline. So so just focusing on what I talked about just in terms of the that sort of pipeline from a development perspective, in terms of what that means for the companies that we work with. We are able to work with companies across that whole kind of innovation pipeline, and there's various stages in which we will do that, and in various ways that we will do that. There's quite a number of members of the Agri-EPI Centre here today, so I'm not going to go into great detail about that right now. But if you want to ask any further questions, or if you want to find out more, you can speak to any one of us, and we'd be happy to talk about what that means for you potentially at whatever stage you're at, kind of in your journey. And that. The way that we work with our stakeholder network. I wanted to just kind of show you this slide because it gives you a bit of a snapshot of how we work and what we have on offer from a kind of an internal ecosystem sort of perspective. So we work really well. As I've said, we're an enabler, we're a facilitator, we collaborate. We're quite agnostic in the sector in terms of what we do. So, but we have these great facilities that we're able to use with our stakeholder networks. And that includes various different innovation centres, whether that is from a kind of a research sort of trial and demonstration perspective, or whether that is further along the pipeline, the innovation pipeline, in terms of showcase and actually on commercial farms, which we have 25 of currently within our network, and those are the white dots that you can see. On those commercial farms, we're able to work with our commercial partners so that we can understand what they need, but the innovators and the technology companies that we're working with can also understand what those challenges are from those farmers and understand how their technology can be applied. So, on to the next one. This then gives a little bit of an overview of our collaborator and stakeholder ecosystem. So there is not really anybody within that sort of field to fork supply chain and sort of the wider sort of periphery of that we wouldn't work with, because we genuinely do believe that there is the strength is in collaboration and bringing people together. So if we're working with some really great tech companies, we will link them in with academics, with scientists, with supply chain companies, so that we can work together to provide the best solutions. And that concludes my part of the sort of welcome. So I'll hand over to Emma now, but please do, if you have any further questions or you want to know anything more about Agri-EPI Centre, please do come and find one of us.
Hi everyone, lovely to be here today, and thank you for joining us in our Moorgate branch, and thanks for the team at Moorgate for having us. And I'm also joined by my colleague from Barclays, Hardeep, who's at the back, so from our High Growth and Entrepreneurs team as well. So big warm Barclays welcome to you all. So I work in a part of the bank called the Eagle Labs, and I lead on climate and nature innovation. And this is where we support startups, early stage startups, on their journey to scale. And if you just go to the next slide for me, please, that would be great. So the labs have about 38 locations across the UK. We've supported about 9,600 businesses, and members have raised over 2 billion in funding to date. So the labs, I guess, if we could go to the next slide, thank you. So we've also been the recipient of the Digital Growth Grant from the UK government, and this has allowed us to deliver a number of programmes. And our kind of programmes, the kind of stuff that we do. So we have dedicated growth programmes with the like for scale-ups and startups with the like of the Cambridge Judge Business School. We have industry specialism, so I specialise in climate and nature innovation. We also have AI, and we have health as well as kind of specialist areas that we support businesses in. We have a demo directory, so if you're an early stage business looking to raise funding, you can put a pitch up in our demo directory, and we have about 300 investors that are connected to that. We also do a series of events and workshops. I'm doing a whole series of getting started in climate tech at the moment, which is something to maybe check out. And we have mentoring and deals and offers. And the great thing about all of this is it's accessible to everyone. You don't have to be a Barclays customer, and there's no charge for startups. So just I know we have a few investors today, so we also have supports for investors and corporates. So if you'd like to be on our demo directory to access these early stage startups, we can also facilitate that. Thank you. So just in terms of climate and nature, just to tell you a little bit about what we're doing, we have a focus on agri-tech, of course. And we have a lab in Lincoln with the University of Lincoln where we actually have, where it's associated with the farm there as well. So that's kind of our core where we support agri-tech businesses. We have a number of partnerships and industry experts as well that we can kind of connect you to as part of these partnerships. And obviously we're here today with our fantastic colleagues. So yeah, I guess I won't go into all of that, but if there are particular supports you need, we're happy to connect you. More broadly in climate, we've got a venture launchpad program at Carbon 13, and we're currently running one on the built environment. We've got our Eagle Lab in Cambridge, which is going to be our new centre for climate innovation startups. And also kind of wider in the bank, we have sustainable impact capital, where we invest in kind of Series A startups that have a sustainability focus. And then just finally, I'm going to talk to you about kind of some programs that we're running that might be of interest for any corporates here today. So the Agritech Bridge program, we've just closed applications for startups, but this is where we connect, I suppose, established corporates with startups and help them to figure out how to work together. So the idea is that we're trying to apply innovation in with, I suppose, match startups with big businesses. And this is a program that we've run with Codebase. We've done it in energy, and we're also doing one in sustainability, focusing on kind of home energy efficiency and retrofit at the moment. And that program is currently open. So I won't take up any more time, because if the discussion today is as good as the discussion we had in preparation for this event, it's going to be very exciting, and you don't need to hear any more from me. But if you would like to learn any more about the programs we're offering, put a QR code, and I hope I've been smart, because hopefully if you take a picture of this will lead you to sign up to our community. But myself and Hardeep are here anyway if you would like to chat to us. And thanks so much, and a very warm welcome to you all. So yeah, great.
So we're going to kick off. Firstly, I'm Tom Slattery. If it wasn't obvious, I'm chairing this debate. I also work with the Agri-EPI Centre, which obviously Rose has introduced, co-hosting the evening. I work with the Agri-EPI Centre on thought leadership, particularly around sustainability, and host our podcast, Seedling Sessions, which if you don't listen to, you must, and subscribe, please. I'd let the panel introduce themselves, because I think they'll do a bit more justice than I will. And I'll start to my right with John Grealish, who is part of AIA that we work with very closely.
Thanks, Tom. So as Tom said, I lead AIA. My background is 20 years private equity and venture capital. AIA exists to advise startups in accessing private capital. And on the flip side of that, investors, helping them originate interesting deals, but also diligence them.
So hi everyone, my name is Greg Michel. So I'm a partner at Cell Capital. We basically invest funds in different themes. I'm responsible for our Agri-Food strategy, which is seed and Series A, basically soil to gut in Europe, Middle East and Africa, and we do food as well.
Good evening, everyone. Ian Beecher-Jones, owner of JoJos Vineyard. It's a 2-hectare vineyard in Henley-on-Thames that we planted 5 years ago. We're an Agri-EPI Centre innovation farm as well, and we're looking at how we can help ag tech companies start down the understanding of working in a farm environment, and just helping them on that journey. But I've also been involved in precision ag for the last 20 years for a global tractor manufacturer, working with farmers from Australia, New Zealand, Canada, South Africa, and all over the world. So I have a good understanding of what growers are looking for when it comes around to agri-tech and data, and understanding that space.
Hi, Simon Evill from Pelican Ag. We're a regenerative food systems venture fund, UK and European focused. Relatively new on the block. We've made 4 investments to date. We are focused, not entirely, but quite heavily on technology which lends itself to driving regenerative outcomes. So we're interested in soil health, we're interested in ecosystem renewal, we're interested in human health and tackling the climate crisis.
Forbes Elworthy, I'm a farmer and forester by background. We we run our home farm on a regenerative basis and have done so for 6 or 7 years, and it's been a great journey. We've got into, eventually, I was in fintech for a while, and we eventually got into agricultural data, and I set up a business called Map of Agriculture.
I think we should jump into it, and I think we can all agree, everyone in this room and the panel, the last few years have been a bit tumultuous, but the last 12 months have been particularly crazy for farming and for VC. So, given the context of that, I think it'd be an interesting question for at least the investors on this panel. What are the current key investment criteria that the investment community are looking for within ag tech particularly, or agri-food tech, and how has that changed since the last 12 months? Now, I think any of you could answer that, but I'm going to pick on Greg and see if you've got anything interesting on that one.
Right, that's going to be a challenge. No, so what has changed? Very good things, actually. Very good developments, I want to say. So let's start with the sort of broad picture of what's been happening. If you're an entrepreneur, if you've been trying to raise money in the last 12 months, you've realized that it's gotten very difficult. It was difficult before, but now it's absolutely expert mode. But that's a function of what's happening in a general market effectively, and with this rates going up, which makes effectively venture funding less attractive, venture investment for our investors, the LPs. Now, just getting back to agtech and what's been happening is there's still quite a bit of money that's been raised still in 2020 and 2021 that has been dedicated to this, and it's growing actually. So today, if you see who you have in the audience and who we're here, so we've got Simon right here, you've got Anthony here, you've got Addy. All these funds that are being raised right now around some regenerative themes, around sustainability within food production systems. So you can see that it's really, that there is a trend towards more money flowing towards it. It's still bloody hard to raise these funds, but we're all out there like very passionate about this. So effectively for entrepreneurs right now, the criteria is what we're looking for. Because of the wobbles at the moment in everything, you've got the same phenomenon that's happening in financial market, whether you're in private or in listed equity. When things start shaking, everyone's sort of going towards safe assets or towards something which is perceived less risky. So from our point of view, and for VCs, what does it translate into? It translates into more of a focus onto maybe businesses that have already a bit of revenues, around experienced entrepreneurs, around things that are a bit easier to get off the ground, and things that we know will get funded a bit more down the line. Because right now, if you don't really know what's happening, who's going to fund your company next, you're that much more careful to choose the companies that you know are going to survive. So that's, I don't know if that sort of answers what you thought, what you wanted from me.
Everybody does. So John, I've got a question coming up for you in a second anyway, but Simon, do either of you two want to add anything to that, or do you feel that Greg's covered it in terms of how the last 12 months have particularly affected VC and the investment criteria? Fine. So, John, we've got an audience here and a lot of our AIA and Agri-EPI audience, and hopefully a lot of the people that watch this online will be either prospective startups, early stage startups. Given that it's a complex landscape, could you kind of give some sort of idea, given that your role as an investment advisory, of kind of what that landscape of investment looks like? So we get them to grant funding, or as Rose was talking, TRL level, X, Y, and Z. What are the possible steps forwards for them?
No, it's a great question, and it's one that is often not well understood by startup teams. Investment isn't their background. It's a bit of a kind of closed shop sometimes. Certainly when I remember going into the industry, and I don't think this has changed, if you try and Google research it, you don't actually get that much insight. Most funds will say they look for similar characteristics in the investments. it's very difficult to form an intelligent view as to which investors you should be talking to at which stage. And actually, that's part of what we try and do at AIA, which is to help startups navigate some of that stuff and take some of that work at least out of the pain, the inevitable pain of fundraising. But I think the first message is the fundraising universe is not homogenous. VC funds are the most obvious source of funding for early stage businesses, and they are a critical piece of the puzzle. Increasingly, though, we are seeing family offices enter the space. Very wealthy families, whether they're relatively newly made fortunes or 20 generations old, family offices are increasingly professionalizing the way they invest. They're increasingly looking beyond traditional asset classes like listed equities or real estate. And a big part of that is because a lot of newly made money has been made by relatively young people who themselves were very entrepreneurial, who themselves are maybe from a generation that is particularly excited by and committed to considerations around impact, around ESG. So those principles are increasingly pushing their family offices to look at sectors like agri-food, sectors that are addressing some of the fundamental questions that the planet faces. So family offices are a big part of this. They also tend to be somewhat more flexible because ultimately, if the family wants to invest in something, they will. Funds are often constrained by their mandate, what their duty to their investors is. So family offices are one that are often forgotten about. They're very hard to find, is the problem. Most of them are publicity shy, but again, that's where really building your network, thinking about talking to other entrepreneurs, whether or not it's in your sector. Actually, anyone from business school, from university, from scientific researchers who've gone into a different field, really work that network. And that's the key. If you're trying to raise money, you're going to have to work bloody hard at it. It takes a huge amount of time. So squeeze every ounce of value you can from your network. So family offices. Then, as Tom alluded to, obviously the grant funding. I think that's relatively well understood. Again, I don't want to be plugging endlessly the Agri-EPI Centre, but we do have a very good team who can help support businesses in putting together bids to access some of that funding. It tends to be for earlier stage businesses. It's not intended, it was never intended to be a replacement for private capital, but particularly for those of you at very early stages of your journey, that funding, A, could be transformative, and B, and this is something the investors further down the line will love, it's non-dilutive. This is not equity, you're not giving away part of your company, and so if there's any money you can get a grant source, I would encourage you to do so. But then, last and certainly not least, is venture. And that's really where the bulk of capital for startups will come from. Now, venture funds come in many flavors. Some will focus on very early stage. Some will focus on later stage. Some don't really mind. Some are sector driven. Some are purely financial returns driven. Some are impact driven. Some will be generalists, some will be ag tech specialists. As Greg alluded to, we've seen a lot more ag specialists recently. But one of the key things that startups need to bear in mind is not just raising money today, but who on my cap table is going to help me raise in 3 years' time when I need to do my next raise. And that's where, if you can get a combination of specialists who bring that kind of halo effect that, hey, they know what they're doing and they invested in these guys, so maybe the ag angle is kind of covered, but also the generalists who have that experience in really scaling businesses. So I suppose, long story short, what are the kind of key important things here? There are multiple sources of funding. Go after all of them. Go after them as early as you can and hit them from every possible angle you can. The earlier you engage with these people, particularly if you're not asking for money, the conversations can be easier, and you can build those relationships over months, years, so that then when you actually do need the money, it's a much easier conversation. I don't know whether that's what you were looking for.
No, John, that was an exhaustively good answer. Great as always. And of course, if you want a longer answer, John is available to chat. Yes. At AIA.com, you can get through the website. So you mentioned something there about it's never too early, but we've talked about this before, and I've talked to Forbes about this as well. Maybe there is a point where it's too early. Do you really want to shoot your shot with investors when it's really, really early? Or is there the potential for that to engage with the investor and them to help you avoid a massive mishap, whether that's you've got a terrible business model or farmers wouldn't want that? So I'm going to put this question out. Forbes, we've discussed this before. What do you think about that? Is there a point where it's too early to go in and start speaking to investors? Could that be positive?
As a sort of serial entrepreneur, I'd say that I always say to my kids who ask me why I work so hard, I say, well, you remember Clausewitz's doctrine of continuous war? Well, when you're an entrepreneur, it's continuous fundraising. You're always at it. There's a couple of other sources of capital that have been really valuable for us at Map of Ag, and that is two wonderful schemes here in the UK, which are world class, and that is the EIS, and for smaller companies, SEIS. It is just great that this country systematically marshals wealthy people's capital, taxpayers' capital, and systematically makes it attractive for them to support people like those of us in this room. And really use it. It is fantastic. They get roughly 30% of their cash back. So for them, when they've given you £1, really they're down to, you could give them their money back at 70 cents in the pound and they'd still be in the money. It is brilliant. And the other thing has been, and it's changed a bit, but the R&D tax credits have been very valuable for tech businesses. And tech is quite widely defined when it comes to R&D tax credits. So, you can, anything that's innovative, even if it's doing research around a new way of explaining a business practice, can be characterized in your accounts as R&D, and that R&D will attract an implied tax rebate in cash of around about 30 pence in the pound from memory. So you have to pay some fees to some terrible sort of accountants and things that help you with it. But it's R&D tax credits are very valuable. So just adding those points, but otherwise I would totally agree. Just I think we'll end up talking a bit later about how the agriculture scene really is and what all this money that's been raised is being spent on. But before we get to that, in terms of having some resource, absolutely. And we've really specialized in raising money from our network because it's permanent capital. Whereas when you bring in institutional capital in the form of VC or private equity, there's an end date. You actually have to deliver, and so try and have some permanent capital from private networks early on to sort of get you through to that period where there is then that sort of more structured relationship.
So just to finish off this kind of part one, first round, Simon, you obviously come from a background of impact investing and now started the UK's first fund focusing on sustainable regenerative investments. What do you feel that there necessarily needs to be a trade-off between impact and, I guess, financial returns when investing in these kind of technologies and innovations?
Yeah, it's one of my favourite questions. Because I've been asked that question for 15 years. I still don't have a really good answer for it.
That's fine.
I come from social enterprise land. I've worked in that space since 2008, and it's more often than not commonplace that there is a sacrifice in the implicit nature of the business model and the value proposition, which limits the potential returns. And that's entirely really down to the context of the business that you're working with. So, for example, if you're in the employment and training space, and I will get back to agriculture, and your mandate is to find job opportunities and to train people who are disadvantaged in the labour market, that will require an additional amount of resource than a conventional recruitment agency. And so there is the essence of the trade-off. So yes, that will apply in this space. And what that means is that broader pools of capital are required, and mixing philanthropy with high net worth, being creative. And a lot of that work has been accomplished in other fields over the last 15 years in impact investing. So and there's plenty of creativity and talent. So I think that it'll take some time, but there will be pools of capital. There are already a few, particularly in the States, that will purposely be seeking out to invest in agriculture and technologies in agriculture, but not with the hurdle rates of and time horizons and return targets that, let's say, our fund has. Where I don't think that there are narrow examples where I don't think that financial returns and impact are not mutually exclusive, and that's where I think the technology has a universal quality. That plays into our strategy. So ideally, we are looking for businesses that have a universal quality. So the value of the technology, let's say, is as useful to a British farmer as it is to an Australian farmer. It's as useful to a British consumer as it is to a Kenyan consumer. So yeah, that kind of like, hopefully in a nutshell, answers that question, kind of.
Well, look, I think it's fair. I mean, it's not an easy question to answer, and I don't think we're going to solve some of these bigger questions here on this panel in Moorgate today, but it's still very interesting to kind of have the discussion and hear your point of view on it. I think we will come back to kind of these bigger issues in sustainability in a bit, but before that, I think we've talked a lot about kind of how to get the money and some advice around that, but what I'd really love to do, Ian, is hear from you as someone who has had the experience of building not just a vineyard, but a kind of digitally integrated vineyard. You've dealt with various different technologies, some that we've tried to partner you with and others that you found yourself. There's an ongoing issue that we haven't cracked yet in agri-food, but particularly in ag tech and farm tech, around fragmentation and interoperability. How have you seen the effects of that, trying to integrate everything on the vineyard, and do you have any insights from your experiences?
Thanks, Tom. It's an incredibly difficult problem to solve, interoperability, because it's interoperability between what? Is it hardware, software, software? Is it people? And people are probably the biggest challenge. They're our biggest opportunity, but biggest challenge as well, about how we bring people together to understand what tech is all about. Now, is it regenerative tech? Is it data tech? Is it hardware tech? Where does that tech fit? And how, as growers, can really smart entrepreneurs enthuse us as a farming organization and as a farming business that the value proposition that they have today at early stages is going to be useful to us longer term. And I think sometimes that is lost in the energy and enthusiasm of an entrepreneur's mind wanting to take it to the market, that farmers may not have the insight that the entrepreneur has, and therefore the messaging is lost. And I have a sort of an experience in that. We've developed a regenerative drill, a direct drill for our vineyard, and we've been talking about it merrily to a number of people. And because of my enthusiasm for the product that we've developed with a neighbouring vineyard from scratch, as soon as I start talking to it, I see people's eyes glaze over because they're lost in my passion, because I go into too much detail too quickly. Where is the vision of what we were trying to do to be able to make it communicable to potential investors that we have, or we go to look for? So we have to be very careful as entrepreneurs to get our messaging right to the grower community as well as to our potential investor community. And if we get that right, it will work. Equally, when we have an idea as entrepreneurs and we want to get farmers involved, how do we do it? Are we going about it in the right way? Because if we can't get the farmers on board, what's the point of going to look for money? Because we then have a problem looking for a solution if we aren't careful. And how many times do we know or have come across stories where it's been a brilliant idea pitched in the wrong way and lost because the problem hasn't been identified correctly? Identify the problem and then the solutions will come, and get that matching right. When that happens, the dynamism is incredible. It is really energetic. And we've had a robot company come in when they first came down to the vineyard a couple of years ago. There was a van load of young engineers rocked up at the vineyard, got the robot out, and within 5 minutes the gearing had broken. And they said, "Oh my God, it didn't do that on the gravel in our factory." And it's a case of, well, hang on, you mean you haven't been out to a vineyard, haven't been out to a farm to be able to look that you're working on grass, you could be working on a hill, and you're working in difficult conditions. Now, to me, that is a fundamental error in the practice of engaging farmers. The reverse side of that was that the energy of the young engineers wanting to solve the problem was really inspiring. So what was a problem with 1 minute, the next time they came, they were full of solutions, full of energy, and that was as a more mature farmer now above 50, to see the younger generation who I don't think would have entered agriculture at all unless it was for ag tech. That was a real enlightening moment, that we're bringing some brilliant brains into our sector that would not have been there before. And that needs to be encouraged and harnessed. But it comes down to the fundamentals of understanding what our market is and who is operating this machinery, whether it's a tablet or whether it's a robot or whether it's a drone. Are you talking to the farm owner, the business manager, or are you talking to the operator? Because the two can be considerably difficult when it comes to execution in the field. And it's having that understanding as funders of these businesses and ag tech startups is who is our ultimate consumer. And actually our consumer in most cases is the operator, because they're the ones who are going to make or break the product that you are making, especially if you're getting out onto farms. And how often are you having that discussion with the interface, your user interface on hardware, software, to be able to make sure that the operator at 12 o'clock at night is still comfortable operating that machine or that piece of equipment. And that's the challenge. If you can overcome that, then the story back up to your potential investors to look for funding becomes a whole load easier, because it's been ground truthed. And the first time you take that piece of equipment into the field, it's not going to break. It's going to work. And I think that is, as an approach, we have to be better at that. And we have to sort of rein in our enthusiasm to do the step-by-step approach, rather than we're having a solution to the whole world's problems through our one piece of hardware or software. It is a long, hard slog. It's not easy. It is difficult. But the energy in this room, when you can present that from a funding point of view, I'm sure will be a whole load greater, and you'll get the farming community on board as well.
Yeah. Thank you, Ian. Actually, that was really amazing. I think it stepped it into a more interesting space. I was going to ask another boring question about whether or not the role of traditional VC funding was even suitable for ag tech. But actually, let's skip that for a minute and build on what you were saying there. So, at Agri-EPI Centre, another plug, a big part of our role is to try and solve that problem of bridging the gap between the tech developer community and the farm community, and it's why we have the Innovation Farm Network, of which you're part of. So John, you bridge the gap between us and the investment community. How successful are we at aligning, tech innovations with real world problems, do you think?
Well, obviously I'm immensely successful, Tom. No, look, seriously, I think I think others may have a better view on this, but very briefly, my view from an investment point of view is that actually this is about not asking the right questions. So it's very easy, particularly in the early stages of a business, to get very excited about the potential. It's very easy as an investor, as a VC investor, to get really, really excited. You don't go into a business like VC, which is very, very high risk, unless you get really excited by the kind of moonshots. So people in those early stages and those early conversations get really excited about how amazing something's going to be and the potential, without necessarily asking themselves those really hard questions. And the way that you address that question of, is there really a problem for this solution, is to think into the nitty-gritty. Well, who's going to buy this? Who's going to pay for this? Who's going to mandate this? How do we sell it? How do we reach our customers? what's the value proposition? How do we get them to switch their behaviors? You've got to drill into those sorts of things. And until you do that, it's too easy to just say, here's a tech, here's a problem. They kind of go together thematically, and that'll work. And plenty of investors have got burned on that. Plenty of management teams have been allowed to get burnt on that because they haven't actually been asked the right questions. And so for me, a big part of it is again, having those kind of route to market conversations as early as possible. And a lot of that, going back to what you were saying, Ian, is about actually talking to the people that will ultimately be the decision makers in whether or not they buy this thing. Figure out the value chain, figure out who the decision makers are, and figure out what the pain points are. And again, there's no shortcuts. It's like the fundraising thing. It takes a hell of a lot of work. You've got to talk to a hell of a lot of people. Yes, brilliant ideas can be come up in little rooms with a couple of people on a whiteboard. Ideas don't solve problems. Ideas don't build businesses. You've got to do the work. That's a partial answer, but it's the best I've got.
Yeah, you did a great job. I threw that one at you a bit unfairly. So look, I've got a bunch more questions, but how about if I squeeze another 2 into the next 5 minutes, and then shall I throw it out to the audience? So if you want to start having a think about some questions, don't want to put it straight onto you. So first up, Simon, what do you see the role of technology and innovation in this much broader question around landscape, nature, environmental problems? And I mean, I threw it at you obviously because of the focus of your fund, but of course, we'd love to hear from anyone else on the panel as well.
Oh, yeah, very good question. So I guess I'm going to add a layer of complexity to everything.
Love that.
So the farm is an environment, it's a habitat, it's an organism. So we've gone down a very, very long path now where we have not been following nature's laws, essentially, in how we manage our farms, how we manage our landscapes. And it's a Gordian knot of problems because it relates to land use and access, planning law, hedgerows, permanent fences. I mean, it's just endless. But what we're trying to accomplish is to identify and to back entrepreneurs who have arrived, I guess, at a similar conclusion to ourselves, which is that to use a really corny finance phrase, the alpha, the great opportunity here is to harness the abundance of natural systems to produce nutrient-dense food and avoid some dystopian future for our children and our grandchildren, in a nutshell. So when we're looking at businesses, we're very interested in whether they have fundamentally understood ecology, whether they've fundamentally understood farmers in the rural community, and a myriad of other sorts of political dynamics that are going on, and have also put agronomics and the economy of those farms front and centre in their novel approach to supporting farmers or the supply chain. We also invest in the supply chain, and further up we'll be investing in potentially consumer brands or businesses that are additive to pulling through more regenerative produce to the consumer. And at the moment, I think that's a relatively small group of entrepreneurs that have that vision and that level of understanding. But I think it's going to build exponentially. In fact, it is building exponentially. It seems that some sort of light bulb has gone off, whether you come from an engineering background, whether you come from a sales and marketing background. People are pouring into this space, and they are doing the similar kind of reading and research, and we're hanging out with similar people to ourselves. And I think that's incredibly exciting. But yes, soil health, farmer livelihoods and profitability, nutrient-dense food. If your technology is not optimizing for those three things, we're probably not interested.
Thank you, Simon. An enlightening answer, as always. This is it. I'll do one more question, and then if no one has any questions, fine, I'll come up with some more. But I'd really, this is one that I've thought about for a number of years now, and I'd love to hear from Ian and from Forbes. So who is and who should be footing the bill for ag tech, and who ultimately benefits? Who wants to go first? I think.
Forbes.
So, I mean, how has agricultural innovation flowed over generations? It flows from the lab, from the entrepreneur, to the ag professional community, the agronomists, the veterinarians, and the animal and seed genetics people, technology people, machinery people, and then it finally gets to the farm. And that whole process is in development economics called extension. How does this stuff get to the farm? And traditionally in the Green Revolution period, it was thought that it was so beneficial to have more production and plenty of it that society would not just pay for the R&D, which we still do, the taxpayer still pays for the R&D at the universities. It was thought that the farm advisors should also be paid by the taxpayer. So we had armies of farm advisors in my country, New Zealand, here in the UK, in America, in Australia. And still in Africa today, they have, I think Zambia has 4,000 extension officers trying to get technology out on farm. But here in the UK and the same in New Zealand, we disbanded the government farm advisory services, and they're now private sector, but they're still just as valuable. And they are firms like Ceres Ag, Brown & Co., Savills, the agricultural parts of these firms do the extension. And Frontier, Hutchison's, etc. And you know them well. And for those people in this room, tap into those good people out there, because they'll be serving 40 farms or 100 farms or 20 farms. And the farmer himself or herself doesn't really have the time to do a lot of the tech, and so those extension networks matter. Who pays for that? It's changed over time. It used to be thought that society would pay for the R&D, which we still do, and the extension. These days, the extension is the challenge. People in this room have probably got some great ideas. How do we get them out on farm? So that's perhaps my answer to that question. It has changed. It's tough, because the farmer isn't really a tech specialist. You're more likely to find a seed merchant or an animal nutrition merchant or a veterinarian who's going to have the technical skills to really pick up on that idea. So latch on to them. Who's paying for it? Hard to say.
Ian, is that you diplomatically avoiding the question? You can if you wish.
No, I'll answer it. I'm not going to duck a question. I think the first thing that comes to mind when we talk about what we're doing for the future from the regenerative side, heard a fantastic saying in Australia in Margaret River earlier this year. You can't be a farm can't be green if it's in the red. And so it has to have a profitable exercise to be able to do all the good things that it needs to do. How it goes about running of the business is up to the farming business itself. But if we're imposing more rules and regulations that are encouraging farmers to go into the red, we're never going to get the green outcome that we desire. When we start to look at ag tech and innovation and trying things out on a commercial basis, there's a farmer in Oxfordshire called Tom Allen Stevens, who's been talking about a subject about risk for farmers on farm and working to help companies trial and develop products. Now, when we're looking at this ag tech, if we're wanting to implement it on farm, there's only one business that is really taking the high level risk, and that's the farmer. We're trying a new product, a new spray, a new whatever, a cultivation technique. It comes down to being on farm. If the crop fails, who picks up the bill? Now, for us as a vineyard, we're only a very small vineyard, but the implications of that are huge. As much as I want to be involved in tech, the switch over from, yes, it's a great idea, it's worked in trials now, to put it in the vineyard is a massive one, and one that is I like taking risks, but that's one I would be very, very nervous of. And we were talking before about how can this risk be managed. The NFU won't take it because of X, Y, and Z. Now, is there an opportunity here for really clever minds in this room, in the venture capital and the funding industry, to take on part of the risk with the NFU, with funders, to be able to go, well, actually, we're backing this fund. There's a pool of money in the centre that goes, it's actually going to be partly industry and it's going to be partly privately funded. So there is that opportunity to recompense the farmer if something goes wrong. Now, we're not willy-nilly going to be trying new tech in spaces that are going to be of high risk. As long as it's gone through trials and tests beforehand, before it's on a commercial aspect, surely this industry should be in a good position to look after and protect the businesses that are going to really, one, take up the opportunity of your new tech and protect it if it goes wrong. Hopefully that is only going to be a small proportion of the time. But if we've got that safety net there as farming businesses, I think the opportunities for ag tech companies, venture capital businesses to invest in them will increase quite significantly, because you've got opportunities to do it on farm. And that's when we're looking at regen, whether we're looking at ag tech, whatever techniques we're looking at for tomorrow. If we can provide that safety net today, one, we'll get a lot more farmers engaging in this space who may not normally have engaged in it, and the opportunities for the end of the day to make money, I'm sure, will be greatly increased if we've got that safety net, because that safety net isn't there yet. And I think that's the one fundamental thing that we have to do as a community, to make all of this affordable. It's affordable, and who pays for it? Well, who pays for it if it goes right is easily solved. It's who pays for it if it goes wrong, and what can we do inside this room and inside this community to help manage that risk.
Thank you, actually, and that was a really, really good, amazing answer, and a good one for my questions to finish on. You won't be surprised, anyone who knows me, we've gone over my time quite a bit, so I'll now hand it over to the audience. Rose, I think, has got a microphone.
Could the panel talk about valuations? Because one of the key issues that we saw throughout all of last year, where funding just fell away, was because companies were either deemed to be overvalued by investors, or wrongly deemed to be overvalued by those investors. How do you get around to valuing a farm? And the farm concept is so broad. It could be mushroom farming to pig farming to vineyards. Just to kind of pick your brain on getting accurate valuations.
So for anyone in the audience that didn't hear that, the general question, but it was a very good question, was around valuations. And I think, Greg, do you want to tackle this one?
The valuation guy. So first of all, when you say startups, I think let's differentiate a little bit between which kind of startup and which stage. So generally, when you have big valuation, movements in valuation, and generally valuations going down, what's happening is, just imagine the seed being an anchor at the front and the back end being, Series B, Series C, Series D, etc. What tends to happen is that this stays more or less fixed, and then this just collapses like this, right? So, and this is effectively what we have seen. So it's all the Series C, all the Series D, etc. that just dramatically collapsed. We just saw, 70%, 80% markdown, etc. Which means for the late stage companies, it's been a really difficult time. And this has been true for agri-tech, for food tech, and it's been true literally across the board. So that's just more around startups. It's not necessarily everyone is the same. If you look at seed, for example, from our point of view in ag, both in ag and food, absolutely zero change, no change at all whatsoever. It's just stayed the same. Series A went down a little bit, but by and large also the same. Mostly in food, it's been, a lot of stuff overheated in particularly cultivated, cell cultivated, etc. that took a little bit of a hit. But then otherwise, it's been by and large the same thing. Now, how do we value companies? Right. I just met a company that we're literally just closing an investment today, and I just met the founder, and he asked me the same question. So how on earth can we just maximize? How can we understand how you guys come up with a valuation? Here's the trick. So anyone who's going to tell us that they're doing DCF at seed and Series A is lying. Do not trust them. There's no way that you can do a DCF at this stage. So how are you going to do it? It's just going to be a function of really two things. One, the amount of money that you're raising, and then therefore the dilution that you're willing to take, which is a direct correlation, right? So if you're raising 3 million, probably your pre-money is not going to be 2 million, if you know what I mean. You're just going to dilute yourself anywhere between, 5, 10% up to 30. Anywhere more than 30, it starts being a toxic round, right? So that's the sort of rule. And then within that, you're just going to look at, but this money needs to be allocated to something, right? It's not simply because you can raise 8 million that you should. right? So, okay, amount of money that you really need to raise, the amount of dilution, and then whether you can command this valuation for two reasons. One, where you are, what your market is, and where the general market is, right? So particularly if you look, for example, at a Series A in cell cultivated, for example, generally because of the capex that they need, they're going to raise anywhere between 10 and 20 million. That valuation is going to be naturally higher. Now, if you have someone who's just doing a software play, an interoperability play in between like machinery and farm management service, that's going to be more of a software thing. So then you're going to need probably a little bit less capex, right? So then naturally, by virtue of where you are and what you're doing, your valuation sort of changes. So that's the second thing. And then the last thing is really the market. What's the market doing, right? If everyone funding Series A at 20 million, then, well, you know, the VCs are more likely to think that, oh, well, I'm going to pay 12 million for this, it's okay. If everyone's paying 12, well, you know, the market's going to be 12. So there's this bunch of things that are happening. Now, the further away you go into the growth of the startup, the less important is the story is, and the more important the numbers are, right? So past Series A, it's effectively all about numbers. It's about your growth, it's about your growth margins, it's about like your unit economics, it's about like how you make money. Right, and so that, and at this point, you start getting like the traditional valuation metrics.
Thank you, Greg. I've heard a lot of people explain that or attempt to explain that, and that's easily one of the best answers I've ever heard. So personally, thank you. Did that answer your question at all?
Yes, because I'm familiar with valuation, but what the problem is, investors are not fully understanding the value of a company and deeming it less valuable very often versus what a company might deem itself. And there's that mismatch, and which is why the market fell away. And so from an investor perspective and from an advisor's perspective, I'm trying to work out how do you guys, boost that valuation or give a realistic valuation to a startup or a Series A, B, C, wherever it is. It's so tricky.
It's up to you, Greg. I mean, I do want to be fair to the other couple of questions there are in the audience. Have you got a quick answer to that?
Yeah, I mean, at the end of the day, also it's supply and demand, right? So it's, if everyone's bidding for the same asset with the same company, the valuation is going to go up. I mean, it's just private markets, right? So it's very difficult to come up with like a definite set of criteria, particularly at early stage, that will result in a particular valuation.
Yeah. Perfect. There we go. Hi.
Hi, I have a question. Smart Oasis Farm, we are based in Agri-EPI Centre, so really great to see you guys up here in London. My question really wants to stick to agri-food tech. We are an innovation company, and it's the commercial viability of the product. How do we tackle the fact that to make an innovation commercially viable in the urban environment is very difficult when we are competing with the prices of the land and real estate in urban environment? To feed London, it's 15.5 million tonnes of CO2 emission every year, yet we are wasting about 1/3 of that in just distribution of the food from farm to fork. So it's not only about innovation being applied to rural landscape and being able to afford it if you are a rural-based farmer, but how do we encourage the urban agri-tech to come into the cities if we can't make it commercially viable because we are competing with the prices of real estate in the cities? We can't have sustainable cities if we do not bring food growers hyper-locally into town. So I'd really like to hear from the panel, from the investment point of view, how to tackle this issue.
Yeah, so yeah, the kind of the bigger agri-food system is an area that I agree. I passionately agree with. I'm just thinking, Simon. I know. Wait. I'll give you guys a choice. I say, Simon, I know this is something we've talked about before a bit, but then Forbes, Map of Ag particularly, you deal further up the food chain than maybe some of the other guys here. So I feel like Forbes looks more confident on this one. So I'm going to. Simon, you want to take it?
I'll give it a crack. I think the best example of sustainable urban agriculture is Cuba. It's Havana. And that started with the crisis. I think, of importing, the inability to import the fertilizer from Russia because of the bed pigs. Have I got my history right? So Havana is full of market gardens out of necessity because literally people couldn't feed themselves. And there's a fertility waste stream, I think, in the byproduct of the sugarcane industry. Is it called bagasse? It's a fibrous material. That's basically the principal compost which goes into that system. Essentially, the entire city is littered with community gardens. I'm sure things have changed recently, but there was a purple patch probably in the 70s and 80s where it was, basically propping up the entire city. So that is illustrative. So if you want to accomplish urban sustainable agriculture, you're going to have to get access to the land, which means you need to browbeat each council and each relevant minister, and you need to leverage the relevant NGOs like RAP and others that are involved in the circular economy. Get all of the people in that particular tribe that are interested in those particular objectives and form a unit, a powerful unit that's just an unstoppable force. It will probably take 5 to 10 years, but you'll probably get somewhere.
I'm sorry, I can't add to that. That was a great answer, and I think it's fantastic that we're starting to do these things, but I just want to pick up on the 5 or 10 years. It just takes a long time to do things in our industry. And there was a question earlier which you didn't have a chance to ask, how suitable is the traditional VC and private equity model who have such and such a time horizon for an industry which is very conservative, and farmers and food companies are responsible for the nutrition of the nation, and they take that very seriously, and so it's very hard for those of us with new brands, and most of us in this room represent new brands, to win the trust of a very conservative industry. And I don't really know what the solution to that is. Really innovative stuff gets funded, but those of us that are trying to build infrastructure for an industry that's changing, and it is changing towards sustainable farming is the coming thing. There's so many forces ranging from finance to banking to the supermarkets to the food suppliers that there's no question that there's plenty of potential to shift our industry to a much more sustainable place, including urban agriculture. But you just have to be very patient with your time horizons and train your investors that it's going to take a while.
Hi.
Can you guys hear me now?
Yeah.
My name is George here. I'm the co-founder and managing director of UB Limited. We're a member of Agri-EPI Centre. So I just want to raise a point, but hope don't offend anybody by raising this point. So there are two models of fundraising. You have the traditional, VC and UVC model, but you also have crowdfunding. As everyone probably know, not to mention names, recently a friend of a company of mine had a difficulty with his, VC, I think round a round, so we had to go back to the crowdfunding, funding route, and had a conversation with the founder last November during our annual event, and he said one of the issues that a lot of the VCs don't understand about his technology or not confident about his track record, even though we were already raised nearly $10 million, 8.4 million pounds. So for new companies and startups getting into this field, maybe some of them are directly innovating, or some of them are transitioning from either UK, ESA, Horizon 2020, etc., or whatever of those. So how would you guys advise, or who kind of to speak to, or even what kind of paths to walk, to make sure that the business has sustainable funding, not just like we got to post it on our website saying that without this X amount of funding or double that X amount of funding, we're going to be shutting shop. Exactly.
So is this a question around kind of newer alternative forms of funding like crowdfunding and crowdfunded debt?
Sort of, yeah. Just want to hear your guys' opinion. So, obviously, I know lots of VCs sitting here, but obviously, because these companies like us, we want to develop that. What kind of potential routes we should take, or even bank loans for this stuff. Yeah.
So I'm pretty sure everyone on the panel's got a point of view on it, but John, I'm going to let you just again in the advisory position. I think you probably cover more of the different options, and as you know, a number of the members we support at Agri-EPI have used crowdfunding to get them from one step to the next?
Yeah, at the risk of dodging the question and answering a previous question you didn't ask me, but I think they tie together well, because part of this is around matching the nature of the opportunity to the right source of funding, right? And this is something investors wrestle with all the time. It's risk versus reward. It's really basic stuff. And the issue is investors get a lot of stick. You don't understand the industry. You don't understand the fact that it's going to take a long time for this business to grow in this industry. That's fine, but the investors have customers too, right? And they've raised money predicated on a set level of return. And so they need to deliver that. So the only way you fit that to a different model is by changing one of the parameters. You can say we're going to be more driven by impact, and therefore we're willing to accept a lower hurdle rate of return than other comparable investors. Or you can say we're going to extend the time horizon. One of the other things that you can do, and I don't think this gets enough airspace, is think differently about portfolio construction. Risk reward is a two-edged thing. Actually, you can accept a lower reward if the risk is lower too. The reason VCs want to see a case of a 10x is because they expect at least half of their businesses to go completely bust. Right? Now, if you can change that paradigm, then you stand a much better chance of convincing that investor to accept potentially a capped return, a slightly lower return, but a much lower risk of losing their money. Because if a VC goes back to their investors and says, right, I've got a 3x fund, their investors are going to be delighted. They're not going to say, you didn't deliver a 10x. They're going to say, blended return, 3x, I love it. I'm going to invest in your next fund. So and the reason I think this is relevant to your question, as opposed to just the previous question, is it's about really understanding, and again, it goes to Greg's point of valuation, really understanding the economic parameters of your business, how it's going to grow, what the right point to sell might be, because it might be that actually the time to sell is 3 years in, you sell it to a corporate for a nice 3x, because you've got a massive IP underpin, but you know what? You're never going to grow it to a unicorn, you're never going to list this thing, it's just not the right solution. And so being really honest with yourselves and seeking really honest feedback as early as possible as to what is the true shape of risk and reward in the business model that you are seeking to create. And if you do that, not only will you be making a more convincing case to the investors, you will stand a much better chance of picking the right type of investor who is looking for the kind of opportunity that you're applying. And I think there's been a lot of mismatch around that, and that's part of the reason that some investors feel a little bit burned in the sector. So I don't know if it's helpful, but...
No, of course, John, excellent answer. I hope that did start to answer it. So we're over the hour.
Can I just provide
Yeah, cool.
Sorry, I know we've probably gone over. I think the best defense for an entrepreneur against the vagaries of us, the investors, is the business. So it's a slightly unhelpful thing to say, but the degree to which you can execute and build something of value on the least amount of money possible, it already puts you into an extraordinary, exceptional category of entrepreneur. If you can get in touch with the investors without taking up too much of our time relatively early on and just get us on your radar and then demonstrate to us that you can execute over a period of time, you're already in the exceptional category. So, yeah, I just wanted to add that.
Brilliant. So we're over the hour. So we'll make this the last question. And so just to be very clear, there's no one kicking you out of here until at least 8, and we have canapes and drinks, and the panelists will be here. So do we want one last question?
Yeah, my name's John Grealish, and I work with companies at the other end. So we're selecting and implementing technology that comes from agri-tech or other areas. So generally they're farming businesses or fresh produce businesses. And one of the things we always look at is how sustainable is that business that we're buying that technology from? Because ultimately, if we take a piece of technology or a bit of agri-tech, it's going to drive efficiencies in our business, and we're going to become part of the core of the business. And one of the biggest worries we have is that business disappears and goes bust, and then we have a massive gap in our systems or in our technology that we can't fill. What advice can you give to agri-tech companies or to investors to actually help give companies like my clients confidence that actually they should be investing or to reduce that risk?
No, I think it's a really good point, and it's something that's applicable to any industry, right? So it was the same thing. We're at Barclays here. Barclays has the same problem, when they find a great piece of tech, and then also it just takes a long time to integrate, right? And once you have this, you really don't want the startup just to die and just to come to you and just say, "What? We didn't raise Series A, so sorry." So that's very difficult. I think on that side, there's just probably two things that you're probably doing them already. But it's a question of understanding. So understanding just the other traction that this company has. Are you the only big client, or there are three of you, which limits again the probability of that event happening. What's the funding structure of the company? So what are the how they're funding themselves, and the kind of people that they have on board. So it's almost, I think, once you get into a partnership like this, I would almost think like a VC effectively. Just look at this company going, does this company have the ability to just survive based on the clients it has, the funding it has, the importance, and effectively the relative importance it has in the eyes of the client in terms of solving their problem. If you think that any of this is lacking, I would definitely just ask myself questions. So that's one thing. And then the second thing is of course what you can do is just try and pick companies that are a little bit more advanced in stage. So conventional wisdom says that the more advanced the company, the least the risk, or the risk just goes down effectively. It's not always the case. Very recently I heard of a company raised like a 30 million Series A 2 years ago, and they just went bust, right? Back then, it would have been just absolutely perfect case, great investors, all that stuff. So it's not, what I'm saying is it's not foolproof as a rule, but tendentially, and that's why, innovation, generally, like the innovation teams of many of the corporates tend to work with Series B onwards, because you're minimizing this risk. But anyway, it's really, really difficult, but I would try and think like a VC, basically.
Or offer the founders a really nice price and buy the thing. I mean.
Look, firstly, thank you to all of you here who have come out on this Thursday afternoon, now evening. Really appreciate you. But I think, can we just give a round of applause and a thank you to the panel. Cheers.